Welcome back to Investing Talk Podcast.
Today, we're looking at Denison mines. The big question is it a good time to buy now? It's a key player up in the Canadian uranium sector.
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis, maybe starting with the fundamentals, the financials.
Okay, yeah. And right off the bat, the sources show something pretty striking. Their balance sheet.
Astonishing is a good word for it.
Yeah, especially for a company doing heavy development work. They've got zero total debt.
Zero debt. In this sector, commodities, which can be so volatile, that's huge. It's a massive strategic plus.
It really is. It gives them insulation, doesn't it? Less risk if the market turns down.
Exactly. Instead of leveraging up for maybe faster growth, they prioritize stability. And look at the liquidity numbers, too. Current ratio is 3.9.
Wow.
And the quick ratio, 3.7. I mean, most companies are happy with 2. They've got almost 4 times the liquid assets needed for short-term bills.
So they're really well cushioned, prepared for shocks, ready to keep developing without needing to raise cash, maybe dilute shareholders.
That's the implication. But, okay, here's the flip side, the profitability. It's a bit mixed, right? Which you'd kind of expect at this stage.
Right. Revenue for the trailing 12 months, TTM, was around $3.31 million Canadian. Not huge.
No, the volume is low because they're really just starting that production ramp up. But the quality of that revenue, the gross margin is listed at 100%.
100%? How does that even work?
Well, it usually means the revenue they did bring in, maybe from specific contracts or asset sales, didn't have significant direct costs of goods sold against it yet. It suggests very high potential profitability per unit once things scale.
Okay, so the potential margin is there.
Yeah.
But overall profit, it's been dragged down by spending, right? The TPM net income was negative.
Yeah, negative $63.28 million Canadian, roughly. And that number, that could definitely scare some investors off if they don't see the context.
The development context.
Precisely. But that's why the latest quarter is so important. We saw a big shift.
The inflection point.
Yes. Quarterly net income flipped positive. Came in around $12.5 million CAD positive. That's the signal. It suggests the ramp up is starting to hit the bottom line.
Okay, positive net income is great news, but we have to look at cash flow too. The operating cash flow was still negative last quarter.
It was, yeah, down about $23 million. And even though they have over $31 million cash on hand, that negative operating cash flow, the OCF, that's the main headwind right now.
So why is that? Positive net income, but still burning cash operationally.
It's about what counts where. Net income includes non-cash stuff like depreciation. Operating cash flow tracks the actual money going out the door for, building things, permits, equipment.
Yeah.
They're still investing heavily in the ground.
Pouring money in to build future production.
Exactly. The risk isn't that it's negative now while they build. The risk is if it stays negative long after they're supposed to be fully producing.
Got it. So that operational spending is kind of future-proofing. Which leads us to their position in the market, right? Their competitive strength.
Yeah, and this is where Denison really stands out. Geographically, geologically, they're a major force in Canadian uranium. And crucially, they hold a 95% interest in the Wheeler River project.
Wheeler Rivers, that's the big one, isn't it? Considered Tier 1 globally.
Absolutely. It's in the Athabasca Basin.
Why is that basin so special? What makes it Tier 1?
Grade. Just incredibly high-grade uranium deposits, much higher than most other places in the world. So your cost to actually mine each pound of uranium should be lower, better margins down the road.
And Denison controls 95% of one of the best projects in that top basin. Like prime real estate, you said.
Pretty much. And we're seeing them execute, too. They started mining operations back in August 2025 at the McLean North Sabre mine.
Right. That was a big milestone. Confirmed they're back in production in Canada. It sort of de-risks things a bit, shows they can do it.
Exactly. It proves the tech works, the method works, gives them actual production volume. It reduces that show-me factor you get with developers. And this all ties into the bigger picture, the macro environment.
Which is looking really favorable for uranium right now, isn't it? Clean energy push, supply getting tighter globally.
Absolutely. You've got surging demand, meeting supply constraints, partly geopolitical, and Denison, with its zero debt,
is positioned to really capitalize without being financially strained.
Right. They can potentially capture outsized gains from their high-grade assets in a stable place like Canada, while others might be struggling with debt or lower-quality deposits.
Okay, so the fundamentals are strong but nuanced. Operations look promising.
Yeah.
What about the technicals? How's the market reacting?
The market seems to be buying the story. The sources point to a strong bullish trend. Remember that big jump over 10% just on October 28th?
Yeah, that was significant.
And the chart supports it. The stock's trading well above its key moving averages. The 50-day is around $2.59 USD. The 200-day is way down at $1.90 USD. Staying above those usually signals strong support, often institutional.
And what are the analysts saying?
Very positive. Consensus is strong buy. You've got 6 buy ratings, just 1 hold. And the average price target for the next 12 months is in a pretty tight range, $2.93 to $3.14 USD.
So basically right around where it's trading now, near $3.07 USD.
Yeah.
Analysts think it deserves to be here, maybe with a bit more room to run.
That seems to be the sentiment. And importantly, the RSI, the Relative Strength Index, is at 53.2.
Okay, so not overbought yet despite the runoff.
Exactly. It suggests there might still be fuel in the tank before you'd expect a major pullback. For traders watching levels, support looks pretty solid down in the $2.50 to $2.70 USD zone.
All right, so the technical picture looks constructive. What about near-term events? Catalysts that could move the needle in the next, say, 0 to 3 months.
The big one, the most immediate, is earnings, scheduled for November 7th, 2025.
What are people expecting?
Strong year-over-year growth. But crucially, everyone will be watching to see if that positive net income trend continues. Is the scaling working? Is it becoming consistent?
That makes sense.
Right.
And then there's the more speculative stuff, M&A chatter.
Right, and we need to stress this is unconfirmed buzz from forums and the like. But there is talk about potential consolidation in North American uranium.
And with Wheeler River being such a prime asset?
Denison naturally comes up in those conversations, either as a potential target or maybe announcing a big strategic partnership. Having zero debt makes them very attractive in that scenario. They don't have to make a deal, only if it makes sense, gives them leverage.
Okay, good point. Now let's be balanced. We need to circle back to the risks. What are the main headwinds investors need to watch?
Well, we keep coming back to it, but number one is still that negative operating cash flow.
Even with the great balance sheet.
Yes. Funding development from cash reserves instead of profits is sustainable only for so long. You need to see that OCF stabilize and ideally turn positive as production ramps up. Profitability can still fluctuate wildly at this stage due to those high operational costs.
And external risks, market risks.
High sensitivity to the uranium price itself. It's a commodity stock after all. If spot uranium prices take a dive, Denison will likely feel it more than, say, a diversified miner. Its 30-day price volatility is noted as pretty high, 5.54%.
So it's a high beta play on uranium prices.
Definitely. So putting it all together, what do we have? You've got this unique mix. Amazing financial health with zero debt and high liquidity, a dominant position in the best uranium real estate globally, plus strong macro tailwinds.
Balanced against those near-term hurdles, mainly the operating cash flow and the inherent volatility.
Right. So overall, the thesis looks strongly bullish. I'd rate it maybe 8.5 out of 10. It's a compelling story for investors bullish on clean energy and uranium, offering both near-term catalyst potential and long-term value from those top-tier assets.
So the final thought for listeners, the key question really is this: can those upcoming Q3 2025 earnings finally show that operating cash flow is stabilizing? Can they cement that positive net income trend and prove that this recent momentum is turning into real sustained value? That seems to be the crux of it going forward.